Hey everyone, last week the Liberation Day tariffs were announced, and if they're implemented as the executive order is written, they'll take the overall net effective U.S. tariff rates up from roughly 2.5% last year to about 24%, their highest level in over 100 years. Today, I'm going to share my first cut perspective on the impact of the policy changes, but first, I want to encourage everyone to join our live webcast on April 21, when Marcus & Millichap's CEO Hussam Najji will host Moody's chief economist Mark Zandi to get his take on the effects of the new tariffs. We'll also be joined by the Real Estate Roundtable CEO Jeff DeBoer, who will offer insights into what's happening with the federal budget and tax outlook. Now, as we've already seen on Wall Street, the dramatic trade policy changes will have significant implications for financial markets as well as the U.S. economy as a whole. And that impact will flow through to commercial real estate. The tariff plan assesses a baseline 10% tariff on all imported goods, then layers on additional tariffs for specific countries. China, which is America's second largest source of imports, will be the hardest hit with net effective tariffs of 54%. Tariffs on Vietnam will be 46%, Taiwan will be 32%, South Korea will face 25% tariffs, 24% on Japan, and there will be 20% tariffs on the EU. Tariffs on other countries will be 10% plus an additional bump ranging between 0 and 40%. Canada and Mexico will still have 25% tariffs on products not included in the USMCA trade agreement. In addition to the tariffs on specific countries, there will be product-specific tariffs as well. A 25% tariff on steel and aluminum, and a 25% tariff on non-US manufactured autos and car parts. There's also the potential for 25% tariffs on pharmaceuticals and semiconductors. Undoubtedly, there will be fallout from this. There will likely be reprisal tariffs by other countries on American exports. We don't know what they'll be yet, but they're probably coming. Now, these trade policies have driven the Economic Uncertainty Index to its second highest level on record. They've caused a significant drop in the stock market, driven consumer confidence and consumer sentiment lower, and as a byproduct, Treasury rates have also declined. From a broader perspective, the combined impact of all these things will likely place upward pressure on inflation, combined with weakening economic growth and potentially a weaker employment market. There are a lot of moving parts here, and the tariff policies remain fluid, so things could change very quickly. But for commercial real estate, the short-term outlook is becoming a bit choppier. If inflation pushes back into the threes and the economic growth weakens, it could put additional downward pressure on confidence levels, in turn weighing on the employment outlook. That combination could slow spending and household formation, which would weigh on demand for apartment housing, retail space, and potentially industrial space. In the second half of last year, apartment demand surged, putting downward pressure on vacancy rates despite the record volume of new apartment completions. But a lot has changed in the last 90 days. Consumer sentiment, which has historically been a pretty good indicator of apartment demand, has fallen by 17 points since December, a 23% decline. That suggests apartment absorption could weaken in the first quarter, but I suspect the true impact will be more apparent in the second and third quarters this year. Fortunately, apartment construction has begun to taper, and as I've mentioned in the past, tariffs could accelerate the decline in construction activity as the cost of construction materials go up. Of course, this will affect different markets in different ways, with high growth, high development markets experiencing a lower net impact to fundamentals compared to slower growth markets that already had very little development in the pipeline. From a retail standpoint, higher inflation and weakening economic growth have historically favored discount retailers and grocery stores, while restaurant sales tend to face greater headwinds. That said, retail vacancy rates remain historically low with a nominal development pipeline. So while retailers will face some headwinds, especially those that are dependent upon imports from China, I don't expect a dramatic change in the leasing climate, at least not over the short to mid-term. The industrial outlook is much more complex. The crux of the changes, after all, are centered on international trade. I suspect it'll take time for the impact of the new trade policies to be felt. It can take 15 to 30 days for a container ship to cross the Pacific. So it'll take time for the logistics volumes to incorporate the new tariffs. And if companies have the option to recalibrate their supply chains and their manufacturing to mitigate the tariff risks, for example, shifting textile production from China with 54% tariffs to, say, the Philippines, which would face 17% tariffs, that would also take time. So I don't see a huge change in industrial space demand over the short term. But over the longer term, space demand could shift from western coastal ports to other parts of the country. The silver lining in all of this for commercial real estate investors are twofold. First, interest rates have fallen and lender spreads have yet to widen. This may be a very narrow window of opportunity to lock in comparatively low rates on debt. Second, commercial real estate has historically been a safer destination for capital during times of economic turbulence, rising inflation, and financial market instability. The impacts of the new trade policy will likely span a relatively short term, the next year or two. And as always, investors need to be able to look past that. They need to consider the relatively sturdy, long-term commercial real estate drivers. Investors need to keep their eyes on the horizon.